Hi, and welcome to Life Insurance 101, presented by the Independent Life Insurance Agents Association. Thank you all for joining us today. In this video, we're going to go over some of the basics of life insurance. This is really beginner material, things that you would learn when you're first getting started, first considering a life insurance career, and you want to learn the real basic concepts. So if you've been in business for a couple of months, even a couple of weeks, this material is probably going to be a little bit too low level for you, so don't feel bad about skipping on to the next video. For everybody else, we want to make sure we're all on a level playing field, so we're going to start off with a solid foundation of good basic knowledge. First, we want to look and talk about what is life insurance, who's involved in a life insurance policy, how is life insurance used, what are the three main types of life insurance, medical versus non-medical life, and how paramedical exams work. First, what is life insurance? Simply put, it's a contract between an insured person and an insurance company whereupon the company agrees to pay a certain sum of money to the beneficiaries upon the insured's death. Basically, a person buys a life insurance policy, somebody else gets money when they die. It's as easy as that. Who are the main parties involved in a life insurance policy? First, we've got the proposed insured. This is the person upon whose death the policy will pay out. The person who has to die for the death benefit to be released. Okay? Your policy owner is the person who owns and pays for that policy. Now, generally, your policy owner and your proposed insured are going to be the same person, but it could be different sometimes. For instance, if a parent has a policy on a younger child, or in a buy-sell agreement where two partners in a business have insurance on each other. The beneficiary is the person, persons, entity, entities, or any combination of the preceding who will receive the death benefit of the policy. So a common setup is for a husband to own a life insurance policy on himself and for his wife to be the beneficiary or vice versa. You'll see companies or entities being the beneficiary of a life policy when you get in a situation where somebody wants to leave money to charity or you're talking about corporate life insurance. The last party involved is, of course, the insurance company. It's the company that's going to be taking the money, taking the monthly premiums or annual premiums, whichever, and paying out the death benefit upon the death of the insured. How is life insurance used? Generally, your simple answer to that question is it's a transfer or creation of wealth upon the death of a person. Life insurance benefits are generally received tax-free. There are a couple of very minor exceptions to that rule that you want to look out for, but that gets a little more into tax law and a little bit beyond what we want to do in this presentation. Life insurance is often used in estate planning, to protect mortgage or other large debts, to fund buy-sell agreements, in the form of key person compensation insurance, and to insure income loss for a family. You also see things like final expense insurance and that sort of stuff. There are three main types of life insurance: whole life, universal life, and term life. Whole life is a permanent form of life insurance protection. It's usually going to be the most expensive of the three main types of life insurance. It's generally used in final expense type cases. Final expense cases are your smaller $15,000 to $30,000 policies that are generally taken out on older or less healthy individuals that can't get more coverage. These policies are often used just to pay for the costs of a funeral and a burial and to tie up a few loose ends upon the insured's death. Whole life insurance is also really underrated when it comes to younger clients, very early 20s and late teens. Whole life insurance at that point in your life is very inexpensive, and since the premiums are level, you're going to get great coverage at a very low price throughout your entire life. It's a great concept and it's underused. Universal life insurance is probably the most complicated form of life insurance you're going to come across. We're not going to get too deep into the ins and outs of how it works, but suffice to say, if you don't take care to guarantee the policy, and when you're illustrating or quoting a universal life policy, you'll see where you can guarantee it, usually to 100 or 121 years of age. The policy can implode. And what that means in very basic terms is the policy will suck the cash value out of itself to the point where there is no longer enough money to sustain it. However, if you guarantee it out properly and fund it properly, universal life can provide permanent protection at a very, very low cost compared to whole life insurance. Universal life is a great solution for low cost permanent coverage. You're going to use this a lot in estate planning cases and in funding buy-sell agreements and in dealing with key persons kind of stuff. Great, great concept. Term life insurance is going to be your most common and most popular type of life insurance. And a lot of this is because term life insurance has great PR. Folks like Dave Ramsey, Sue Zorman, buy term, invest the difference. Everybody says it. Everybody buys term. A lot of people don't invest the difference, but it's become very popular among consumers. It's generally the least expensive option among the main three types of insurance. And that's because it's a temporary risk. It's a temporary form of insurance, and so it should only be used to insure temporary financial risks. Things like a parent that wants to ensure that if they pass away, their children have enough money to go to college, or a short-term loan or a mortgage, things like that. Things that have a definitive endpoint in the future where the risk will dissolve. Permanent risks should be handled by permanent insurance, but term life insurance is a good solution for many of your temporary risks that you're going to run across on a day-to-day basis. And chances are you're going to sell more term life insurance than any other type, just because consumers like it so much. Let's talk a little bit about medical versus non-medical policies. Each of the three types of policies we've talked about, whole life, universal life, and term life, come in medical and non-medical types. Medically underwritten policies are policies that have more health questions on the application, generally include a check of the MIB, that's a Medical Information Bureau, and might require an APS, it's an attending physician statement, and will require a paramedical exam. Paramedical exam is where an examiner will come out to your client's house or place of work, or the client can go to them if they like, and they'll perform a really basic physical. Generally, they're going to draw blood, measure height and weight, take a urine sample, and check the blood pressure. Sometimes, depending on how much insurance you're getting, there may be a little more or there may be a little bit less. Medically underwritten policies take longer to issue because of all this stuff. It takes time to process parameds. It takes time to schedule this stuff. It takes time to get everything, all the documents, all the paperwork in the proper place. Non-medical policies are quicker and easier to issue. They don't require a lot of the legwork and a lot of the medical checkouts that medically underwritten policies do. So non-med policies are often good for folks with a couple of perhaps sketchy health issues. However, they tend to be more expensive, so that's something always to look out for. We talked a little bit, just very briefly, about how paramedical exams work just a second ago. We were talking about medically underwritten policies. Parameds are always going to be necessary for a med policy. Different companies, different insurance companies are going to have different requirements. Check your guidelines. What paramedical requirements do you need to order? Do you need an APS? Do you need a urine sample? Do you need a blood sample? Check your underwriting guides. It's very important that you keep on top of this. You're going to be able to find this kind of stuff, like I said, in the underwriting guide. There's going to be handy charts that show you what requirements you need for what ages and at what coverage levels. Many different paramedical companies operate in the U.S. You got Portamedic, Superior Mobile Medic, Apps Live. There's a lot of choices, so you can shop around different paramed companies and kind of get a feel for the one that works best for you in your area. And just as a side note, parameds, of course, are going to be paid for by the insurance company. This stuff is not going to come out of your pocket or out of the client's pocket. And that's it for Life Insurance 101. Thanks for watching. If you have any questions, please feel free to email us or head over to the forums and ask your fellow agents. We're there too, so we'll be happy to help you out. Thanks.